In the stock market, well over 500 million shares are traded daily. If this seems like a frantic, confusing, and mysterious place, it's not. But it is the most profitable subject you didn't learn about in school. The stock market. Simplified. The stock market is open about 250 days per year. Each day, investors and traders buy and sell stock. Stock is a tiny piece of ownership in a company. The law of supply and demand drives the price of stock shares up and down. More people want to buy and the price goes up. More people want to sell and the price goes down. Investors buy stock because they believe the company will do well and that the value of their shares will increase in value as a result of the company doing well. But that theory doesn't always work out. The price of a share of stock is not tied to company performance. World news affects stock prices, government policy affects stock prices, buyers and sellers affect stock prices. Normal people, who are typically too busy working to understand how to become wealthy, invest blindly in the stock market because they were told to, blindly hand money over to their company's retirement program because they were told to, blindly put money into the stock market because they have no idea what else to invest in. More on how normal people and wealthy people think differently about money in a later video. People who blindly invest typically do so because they're told that the stock market historically goes up by an average of 9% a year. If you invest $100,000 and make 9%, you made $9,000 in 12 months. That's $750 a month and a horrible use of $100,000. There's no guarantee that you'll make 9% each year. Making the average return involves good timing. Invest in 2007, stock market falls 35% in 2008, and your $100,000 investment is worth $65,000. Just to get back to break even, you'd have to make 54% on your remaining $65,000. In an average environment, 6 years later, you'd be back to break even. Investments in the stock market come in many forms: individual stocks, mutual funds, ETFs, and hedge funds. If you buy an individual stock, you need to buy lots of them to protect against one company doing badly, and you have about 15,000 to choose from, so pull out the dartboard and start picking. You can choose a stockbroker to help you choose, but keep in mind that they make money when you trade, not when you make money, and if they were really good at trading stocks, why would they be chained to their desk from 9 to 5 each day? You can use mutual funds where lots of people throw money into a bucket and allow professionals to make the decisions, but they're not flexible. They have to keep your money invested in the things that they say they will invest in, even if they think that that's not a good idea at the time. They consume some of your return with fees and historically underperform the sector in which they invest. ETFs are computer-managed representations of the entire stock market or segments of the market. They're great if you want general exposure to part of the market, but you have over 1,500 to choose from. Some go up when stocks go down, some go up more than stocks when stocks go up, and yet again, get out the dartboard. Hedge funds are fantastic, and probably your best bet if you want someone who's really good at making money to manage your money for you. Great flexibility. The manager can do almost anything he wants with your dollars. Great setup. The manager makes some money when you join, but he makes most of his money only when you make money. But you have to be super rich already to invest, with most of them requiring a minimum investment of $1 million. Also, buying and selling stocks are traders. Traders trade stocks because they think that the stock will go up or down. They derive their trades from things like news, technical analysis, stock scanners, and hot tips. Unfortunately, some traders sometimes make trades for really stupid reasons, which is part of why stock trading sometimes gets thought of as dangerous. When you trade, you can benefit from a stock price going down if you short sell the stock, the simple process of selling shares first, then hoping to buy them back later at a lower price. Swing traders enter trades with the intention of remaining in the trade for a few days or weeks. Day traders trade intraday. They get in and out within the same day. Scalpers want to stay in trades for a few seconds or minutes. Some big firms employ supercomputers that high-frequency trade, and it's the ultimate scalping system, trading millions of shares each day with trades lasting fractions of a second and making lots of money in the process. Unfortunately, they're not available to normal people. More on the stock market, stock trading, and why you go to work every day but I don't in the coming videos.